Welcome to The Explainer. Today, we're going to break down the fundamentals of the investment landscape so you can create a personal blueprint to navigate your own financial future. Okay, so when it comes to investing, most people start in completely the wrong place. But as the leadership guru Simon Sinek famously said, the best approach always starts with one simple question: why? And that's exactly where we're going to start today. We hear questions like this all the time. Which mutual fund should I buy? Is it a good time to get into real estate? What's the hot stock right now? The focus is always on the what. But here's the thing. What if I told you that's actually the wrong question to be asking? At least not first. Before you can ever figure out what to invest in, you have to understand the most important part of the entire equation, and that's you. Right, so the whole conversation has to begin with your personal why. Are you investing for retirement in, say, 30 years? A down payment on a house in 5? Your kids' college education? Your specific financial goals are the entire reason for investing in the first place. And look, before you can even think about investing, you really need to have some savings. But these two things do very different jobs. Savings is all about preservation, keeping your money safe and easy to get to for short-term needs. Investing, on the other hand, is about growth. It's about putting that money to work to build wealth for your big, long-term goals. So once you know your why, then you can start to look at your options. It helps to think of all the different investment types like their building materials. Each one has unique properties that are good for different kinds of jobs. These are the 4 main players, your core building blocks. You've got the stuff you can literally touch, like real estate, actual property, and commodities, which are raw materials, like gold. Then there are the purely financial assets. Equity means you're buying ownership in a company, a share, which gives you a claim on its future success. And with fixed income, you're basically the lender. You buy things like bonds, and in exchange, you get predictable interest payments. Each one plays a really different role in building a solid portfolio. Of course, anytime you invest, there's going to be risk. But the key isn't to be scared of risk or to try and avoid it completely, because you can't. The real goal is to understand it so you can manage it. First up, we've got inflation risk. I like to call it the silent thief. This is the danger that the money you save today is simply going to buy you less stuff tomorrow. If your investments aren't growing faster than inflation, you're actually losing money. Your purchasing power is shrinking. And check this out. If inflation averages 4%, $100 today would lose about a third of its buying power in just 10 years. That really shows you that even just keeping your money in cash isn't perfectly safe. Next on the list is liquidity risk. This is basically the risk of not being able to sell something quickly when you need the cash. A house is a perfect example. It's a great asset, but it's very illiquid. You can't just sell it in an afternoon if you have a financial emergency. And finally, you have market risk. This is the big one. This is the risk of the whole market going up or down because of huge factors like the economy, politics, or global events. It's the one risk that hits almost everything, and you can't just completely get rid of it through diversification. All right, now for what I think is a truly fascinating part of all this. Sometimes the biggest risk to your money isn't out there in the market. It's right between your ears. I'm talking about the glitches in our own thinking, known as behavioral biases. You see, our brains are wired with all these little mental shortcuts that help us make quick decisions every day. But in the world of investing, those same shortcuts can lead to some really irrational and very expensive mistakes. Let's just touch on a couple of the most common ones. First, there's the herd mentality. This is that powerful gut instinct to just follow the crowd. We see everyone else piling into a hot stock, and we feel that pull to jump in too, a lot of times without doing our own homework. This is exactly how investment bubbles get started, and it almost never ends well for the folks who follow the herd off the cliff. And then there's confirmation bias. This is when you make a decision, say you buy a stock, and then you only look for news and opinions that tell you how brilliant you were for buying it. You just ignore all the red flags, all the warning signs. It feels really good to be right, but man, is it a dangerous way to invest. So you've got your goals, you know the asset classes, you understand the risks, and you know your own brain might try to trick you. How do we pull all of this together into a strategy that actually works for us? Well, the answer is a simple but incredibly powerful concept called asset allocation. It's not about trying to pick the best stock. It's about creating a master plan for your money, deciding how to split it up across those different building blocks we talked about earlier. And it really comes down to this simple 3-step blueprint. First, you define your why, your goals, and your timeline. Second, you figure out your personal risk profile. How much of a roller coaster ride can you actually handle? And third, you allocate your assets in a way that lines up perfectly with those first 2 steps. You see, when you start with why and you build a plan based on your own unique situation, you stop being a speculator, just reacting to the noise. You become an architect, strategically building your own financial future. The blueprint is yours. The only question left is, what are you going to build?